Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Yesterday's video we talked about my watch list. Okay, if you haven't seen that video, go and watch it. Let me know what you think. And one of the things that we talked about was that I've got about 7 or 8 companies that I would like to add to my portfolio in the future. Not all of them obviously, but they were on the watch list and I was basically watching them to see out of all of those which one will be actually good fit for my portfolio. And some of those were REITs, okay, real estate investment trust companies, okay. And what we want to do today is look at that list and see out of those companies which one we think hopefully will be a good fit for my portfolio. And that's what I want to do today. So I've got 7 companies in the real estate investment trusts sector, okay, that could potentially be added to our portfolios. Now again, I'm not a financial advisor, I'm just giving you an overview. One of the things that you really have to be careful as a someone who is investing only companies that are Sharia compliant is to be careful with the debt when it the debt with these companies carry. A lot of these companies deal with have higher debt. They deal with some of them interest, some of them deal with mortgages and all of that stuff. So you really have to be careful. But the ones that I picked today are currently, right now as we speak, Sharia compliant according to Zoya and other companies, okay? And in terms of their business, there's nothing to worry about. But in terms of their debt levels, that's the one that you should actually pay attention to and be careful with. Right, so let's start first. Let's talk about what real estates are. So real estate investment trusts are normally have these rules, okay? In order to qualify for that, they have to basically pay attention to these rules. And the first one, it says invest at least 75% of the total assets in real estate, cash, US treasuries, and so on, okay? 75% of the gross income from rents, interest on mortgages, or basically they have to come from 75% of their gross income, either from rents, interest, and mortgage. We're not dealing with mortgage, okay, or interest, financial, real estate, real property, or real estate sales, okay? So again, we're not dealing with anything to do with interest or mortgages and so on. For us, majority of it will be from the rent. Pay a minimum of 90% of taxable income in the form of shareholder dividends each year. So that's a requirement. So 90% of the money they get, they have to pay as a dividends. Now, this is one of the reasons why a lot of people, especially if you are retiring, you're getting closer to that age of retirement and you want that solid income, although they're taxable, you basically, it's easier to invest in real estate and get that cash, okay? And then obviously there are a couple of other rules, but that's, in terms of the taxable as a corporations and managed by board of directors and so on. And then 100% of shareholders after its first year of existence, and have no more than 50% of its shareholders held by 5 or fewer individuals. So these are the things that the company has to follow in order to make sure they are a REIT, or they have to qualify for that. The next thing is, what are the types of REITs? Okay, so you got publicly traded and basically publicly non-traded REITs. But within the publicly traded, we have equity REITs, mortgage REITs. So the equities are basically income produced in real estate. Mortgage, you know what mortgage REITs are. Office REITs, industrials, retail, hospitality, residentials. These are the type of basically buildings that exist, or infrastructures, whatever, or data centers, or some of them have specialties. So they do like a diversified REIT. Some of them will do just storage. Some of them will only focus on healthcare. So they will build the hospitals. They will build those medical places where people can actually rent out and so on. So these are the types of REITs that you will be able to find. So the ones that we're really interested in is the residentials, the healthcare ones, the storages, the infrastructure, the data centers. Those are the ones. So we're going to stay away from any company that's dealing with the mortgage side of it because of Sharia compliance side of things. Okay, so that's in a nutshell what REITs are. So let's have a look at the 7 companies that we've got on the list. And the first company we're looking at is DLR, and that's a digital realty trust. This is a data center facility, so it provides data centers for other companies, okay? And what is basically what's called specialized REITs. Currently trading $142 per share. It has a market cap of $40 billion, and price to fund from operations, which is very similar to PE. Okay, it's about 23. Okay, so what we normally look for is anything that's below 20, just like a normal PE. They pay dividends 3.20% annual payout. So this is the cash you will get for every share that you own. So $4.88. Adjusted FFO payout ratio, which is similar to, again, the payout ratio. And what we're looking for is anything below 90%. Okay, so 90% is good. So 75% for this company, 5-year growth rate of 6%. Dividend streak, so this is the dividend, how long they have been paying the dividend, not how long they have increased this dividend. Okay, so you have to be careful. So this is, they have been paying the dividend for 17 years in a row. That doesn't mean they have increased every single year. Okay, some of them, they don't actually increase it as much. Dividend safety of 94%, so that tells me the company is safe. They are paying 3.20% as a dividend, and that seems safe at the moment. According to Morningstar, is fair valued at the moment, and price target is $133 per share, and as you can see, is right now $142 per share. So if you were thinking adding that to your portfolio, you might just want to wait a little bit just for it to come down maybe a little bit more, and then add it, because that will give you a margin of safety. That's really important as an investor. If you read the Intelligent Investor, they've talked basically, Benjamin Graham always talks about margin of safety. Warren Buffett always talks about that, because you never know. Even though these analysts are saying, okay, the price should be 133, and if you buy them, basically it will be a good blah blah. It's always be nicer to have that cushion just in case anything happens to the earnings or to the company generally. Right, so that's the first company. So what I would do if I were you right now, okay, if you wanted to know more about this company, then you need to do a little bit more research. You need to go to company's website. I'll show you one quickly, an example of it, but you can go to the company's website, find out exactly where their data centers are located, who their clients are. So are they some of the clients, are they the Googles, the Microsoft, and all of those companies? And if they are, then you're in a safe place, and so on. Find out basically the last 5 to 10 years, their earnings, for example, okay, the revenue. Have they actually increased their revenue every single year in the last 5 years? Have they increased their dividend? Have they actually got net income there? What does it look like? How much free cash flow does the company have? There's so many things that you need to look at. From the business model, are they just located in the US, or are they located around the world? That's another thing that you need to look at. Okay, so the next company is Duke Realty Income Corporation. Is operates a portfolio of primarily industrial properties. So that's what they do. So they rent basically these spaces to the industrial properties. So they rent it basically to other companies to use them in that space. Okay, so they don't actually rent it to individuals, but to industrials. Currently trading $52 per share, $20 billion in market cap, 35. This is actually quite high. So price to fund from operations is actually 35. Dividend yield just about below 2%. Annual payout $1.12. I don't know if they pay monthly. Actually, I'm not sure if they pay, but quite a few companies in the real estate or the REITs, basically they pay monthly dividends. I think this is one of, I'm not sure it is actually. I think it's a Stag. That's the one I think. Stack is also similar to this company. So annual payout $1.12, 66% of adjusted FFO payout ratio, 5-year growth rate 8%, which is actually quite good. Dividend streak of just 3 years, so they have been paying this dividend for 3 years. Safety is about 50%, fairly valued at the moment. Price should be about 53, currently trading for 52. This is probably a safer bet than this one here, okay, because this price is higher than this one, whereas this one is actually higher than the current price. So you might want to wait maybe another 2-3% drop if you were interested in that company. Again, do your due diligence before you do that. The next company is Avalon Bay Communities, and this company owns a property of 275 apartments, basically apartment communities. Okay, so they basically build apartments and rent out to individuals and so on. So it's a residential REIT. currently trading $220 per share, market cap of almost $31 billion, price to free cash flow, price to fund from operations is about 30, dividend yield 2.5, annual payout of $6.38. That's 36. That's quite high actually. $71.07 when it comes to the payout ratio. 5-year growth rate is about 3%, which is not great. Dividend streak, basically they have paid this dividend 27 years in a row. So this is the kind of company, because they already are a dividend aristocrat, they most likely they will carry on paying this dividend, because they are dividend aristocrats, a company that pays their dividend 25 years or more. After the 50 years is actually dividend king. So the fact that they have been paying this to over 27 years is really a good sign. Okay. Dividend safety, really, really good. I mean, 99 is the highest. They've got 98%, which is really good. Fair valued at the moment, and then $234 per share. Right now is $220 per share. So maybe that is a little bit of margin of safety. Okay. Again, it's a fairly valued at the moment. Next company we're going to look at is Castle International. This company owns and leases roughly 40,000 cell towers in the US. Is again residential REIT. Is it? Okay. Can't be a residential. I knew it wasn't. My bad. That was a specialized REIT, not residential. Okay. Currently trading $184 per share. Market cap of $78 billion. Price to fund basically is about 27, which is not great. Okay, almost 28, and then dividend yield of almost 3%. Annual payout of $5.88 and 79% payout ratio. 5-year growth rate of 9%, which is actually quite nice. That's the highest that we've seen so far. Dividend streak is 7%, 7 years in a row. Dividend safety 61%, which is not bad at all. And then when it comes to being overvalued, it is a little bit overvalued at the moment. 34% overvalued. It's not a little bit. Okay, $135 per share according to Morningstar, and right now is $184 per share. So this is one of the companies, I think not long ago they were not compliant, Sharia compliant, because of the debt levels. So you have to be careful with this company. They might go back to that situation again. Okay, so you have to be careful when you actually look into this one. Okay, the next one, Equinix. This company owns data centers, just like the Digital Realty Trust and Special REITs. Again, $715 per share right now. Market cap of 63, almost $64 billion. This company has been on my radar for a very long time, but it's always been overvalued. So I don't think it will ever come back down to where we want it to be. But they have a PE of price to fund from operations of 28, dividend yield 1.61, which I think is quite low for this type. But again, you actually get almost $12, over $12 per share that you own. Payout ratio of 43, 10% 5-year growth rate, and for 6 years in a row they have basically paid this dividend 86%. So it's quite safe in terms of dividend safety. 25% premium at the moment. The price should be $550 per share. Right now it is $715 per share. So it's got a long way before I would add this to my portfolio. I would love to. I wouldn't hesitate to add in this. I've watched a lot of videos on this company a while back, and I really wanted to add to my portfolio. I think we've talked about this before as well, but it's too expensive, really too expensive right now. Next one is Stack Industrials. Again, is warehouse and distribution buildings. It's industrial REIT, currently trading $336. Okay, market cap of just $6.5 billion. So it's quite a small company. 21 when it comes to price to fund from operations, just about above 21. Dividend yield of 3.5. Wow, that's quite good. And annual payout, this is definitely a monthly dividend payout, I think. Okay, for $1.46, and the payout ratio of 74, which is not bad because we're looking for anything below 90, right? And payout ratio, just the one, I've just realized. Okay, 5-year growth rate, just 1%. Wow, that's really bad. Just one? Let me just double check this. Right, so let's go to where that is. Oh, it's 1%. Wow, that's interesting. But 10 years is about 7%, but 1 year, 5 years is only 1%. So very, very low, very slow. All right, dividend streak of 10 years, payout, dividend safety of 45. So this is playing with fire, I guess, but it is discounted at the moment 5%. So 38. Okay, currently trading 36. So I would say this, for me, probably this is a pass, considering the dividend safety as well as the growth side of things. But if you're interested in the cash, okay, and currently undervalued, if you own it already, you might as well just add to it, because it seems undervalued at the moment. Okay, 38, 60 cents, and then 38. Okay, 36. Right, so that is stack, and then final company is Public Storage, and this company is a self-storage facilities. I was doing a little bit more research, and I'll show you that in a second. And they actually own a lot of properties in the UK as well, which is quite nice to know. Currently trading almost $50 per share, $63 billion market cap, 36 PE, dividend yield or price to fund from operations, dividend yield of almost to 2%, payout is about $8. They pay you $8 for every share you own. Payout ratio 57, which is quite nice. Okay, payout in terms of growth, just 2% in the last 5 years. Dividend streak of 29 years. So they have paid that dividend of over 29 years. Dividend safety 96, which is really good. So the highest so far is AVB, and right now this is 96, fairly valued, $340 per share, 349 at the moment. Right, so out of all of this, I'll be honest with you, the ones that I'm interested is Public Storage. Okay, the reason I'm interested in this company is because how diversified their self-storage facilities are, how easy it is to manage and all of that stuff, and they're worldwide and so on. I'm definitely interested in the data centers as well. Okay, I do like the 2 data centers, but out of 3 of them right now, probably this is the one I would possibly add, maybe next, if it comes back to the price range I'm expecting. Again, even though it's 340, okay, I would like to have maybe 5% or more a safety, or margin of safety, basically. And that is my take on these companies. Okay, very quickly, let me show you what I would do if I was in your shoes and I'm interested in any of these companies. Okay, what I will do is go to PSA, Public Storage. Okay, look at the dividends in terms of the safety, read about the company, look at the payout ratios and all that stuff we looked at, how long they have been paying these dividends, how much they've paid in the last few months, whether basically is overvalued, undervalued. Look at the adjusted and FFO payout ratio, free cash flows. Again, look at the FFO per share, that's increasing. Again, all of these things are very, very important. Shares outstanding, for example, it has stayed the same for a long time. Then they increased it a little bit, so that's a little bit worrying. Total sales is increasing in the right direction. That's in the billions. So from 1.89 to $3.71 billion. Then you look at the return on equities, return on invested capital, margins. Then you go to the company website. Then you look at the investor section. Then you look at the latest reports that they've got. One of the things they've got is this presentation here. They've got YouTube video there about 15 minutes long that they talked about different things. They've got the portfolio question and answer thing. Now within this one, they've got so many graphs and things to show you the company. So in terms of storage facility utilizations from 1987, that's the year I was born, and all the way to right now. Okay, so they've got so much information in there. So if you're interested, don't just rely on this thing that we just talked about. It's really important to look at these things. Okay, so have a look at all of that, look at who's involved in the company, and then you can look at the actual company website and see where the companies they own within this. So in the UK, they're not called public storage. They have a different name. So you need to find that out and where they are and so on. So there's so much information that you can just gather from without just looking at the financials that from these companies. Okay, so don't just look at the financials, look at the company itself, because that will give you an idea of where the head company is, where it's heading and so on. So that's my take on these REITs. Okay, like I said, this is the one I'm really interested right now. Duke Realty Income Corporations will probably be what next one, or this one here, I don't know, we'll see anyway, but this is the one I'm doing more research on, and possibly if it comes back to the price range that I'm looking for, then hopefully I can add that to my portfolio. And the reason I want to do this, okay, if you go to my portfolio, just quickly show you here. Okay, if you go to my portfolio, if I can get there, okay, the income portfolio, one of the things that I want to make sure is well diversified. Okay, so diversification is really important, especially in this kind of climate we're in right now, where some things are not. So for example, tech companies were amazing, doing great job, and now all of a sudden they're no longer doing what they were doing. They're not going up 2%, 3% every single day, right? So you have to have a diversified portfolio, and real estate and energy have been doing really, really well in the last few months. Okay, so the companies that the sectors I would like to add in my portfolio now is energy, real estate, and financials. Those are the three I'm looking at right now. So I hope you enjoyed the video. I hope you enjoyed the transparency and everything else that I'm doing here. If you did and you're watching this video up to 20 something minutes, I appreciate you. Just give it a like, and thank you so much. Let me know if you have any questions. Assalamu Alaikum.